Friday before spring break.
Alright, we're going to go ahead and get started. Welcome back. Anybody go anywhere fun for spring break?
My bedroom.
Your bedroom? No, not your bedroom, but I stayed at home, didn't do anything fun. Nobody looks tan, so nobody went anywhere warm, I would guess. Alright, we're going to pick up talking about long-term liabilities, but before I do, anybody have any issues with the midterm or with midterm grades or confused about anything up to this point?
How are the overall grades?
Or what?
How are the overall grades?
Just as a class? I'm a super easy grader, so they were good. No, they were pretty good. Midterm wise, obviously I gave y'all more than one attempt, so I mean I looked to gauge how everyone was doing. I looked at your first attempts and then kind of looked. Most people did pretty well after the second attempt. Some people not as good on the first attempt, but overall I'm not too worried where y'all are at. If you guys are fine with where you're at. All right, so we're going to talk about long-term liabilities today. I've already posted some examples to go with this chapter online. Basically, you know, we talked last time that I lectured anyway about corporations and about why you might want to form a corporation. So a business typically is going to form a C corporation primarily these days because they need money. They need capital to operate the business, to grow, to pay people, whatever their needs may be, capital-wise. They need some money that they don't have, and they're not willing to wait or able to wait until they organically generate that money through net income year after year. Right? So if you need money, you have a couple options. You can either incorporate and sell ownership shares, which is what a corporation does. And thereby, when you sell the shares, people pay you money. You use that money to grow, but you've given up some of your ownership value of the company. Okay, so you have that option. And then you also have the option of debt, right? If you want to use debt to grow or to function as capital, that option is available as well. So when we talk about that type of debt to fund capital or to fund growth or expansion or whatever, that's when we're typically talking about long-term liability. So again, short-term to long-term, the distinction is 1 year typically. Anything that is going to be paid out in less than a year would be short-term, and then anything that will come due in more than a year would be long-term. We're talking about loans that essentially loans that will be paid out in more than a year's time or over the course of more than a year. Okay. So within that categorization, we're typically going to talk about from the perspective of a company, either bonds or notes payable. Okay, those are the two main forms of debt financing that we could be talking about. When we talk about bonds, a bond, I'm sure you guys have heard the term bond before, but a bond, all that really is it's a company selling as a commodity, kind of like a stock, debt, right? So a company says, hey, I want to borrow money, and they go talk to some type of investment bank or some other type of bank that handles these types of transactions, and that bank then goes out and sells the equivalent of basically shares of this debt, which is what bonds are. Okay? So what that means is more than one person, and it could be many people, could have an interest in these bonds because they're sold on the open market, just like stocks are. Okay, and they have terms. So the terms of a bond, the important nuggets that are part of a bond are how long is it, the maturity date, the stated interest rate, which you see right there, and the par value. Okay, so the par value is going to be the amount that you repay at the end of the maturity date. Okay, so in this case, 20 years later, you will have to repay whatever the par value is. Okay, so when we talk about bonds, that par value is not always the amount that the bonds sell for. Sometimes bonds sell for more than their par value. Sometimes they sell for less than their par value. The reason is because when the company issues these bonds at whatever the stated interest rate is, that stated interest rate doesn't change. You have that stated interest rate, and then those bonds are out on the market, but the market rate goes up and down. So once these bonds hit the market, they're subject to the market rate. Well, if you try to sell bonds that pay 9% interest, so anyone who's buying these is thinking, okay, I'm earning 9% on my money if I buy these, but the market, they can go out in the marketplace and get bonds that pay 10%. Which bonds are they going to get? Well, obviously they're going to get the ones that pay them more, right? So if I'm trying to sell my bonds for 9% when the market rate is yielding 10%, I would have to incentivize these bond purchasers to buy mine instead, and I would do that by saying, hey, instead of you loaning me the full amount right up front, $800,000, why don't you loan me $750,000 up front? I'll still pay you the 9% interest that's stated, and I'll pay it as if you had paid me the full $800,000. Okay? So the par value and the stated interest rate, no matter what the market says, the par value and the stated interest rate, that tells the purchaser what the cash flow of this investment is going to be. Okay? And if I sell it at a premium or a discount, that adjusts what the amount of money that's coming in at the outset. So if I sell a bond at a premium, it means someone's going to pay me more than I'm going to pay them back at the end of the bond. Okay, this bond's payable component, that holds the amount that I will pay back at the maturity rate of this bond. So if someone pays me more than I'm going to pay them back, the only reason they would do that is if they're getting an interest rate on my bonds that's much higher than the interest rate in the market. So that makes my bonds very appealing, and so I can say, hey, since my bonds pay so well, you have to pay me more money up front for me to sell you these bonds. Okay? So that's bonds selling either at par value, at a discount, or at a premium. And that's pretty much all we're going to talk about in terms of bonds. I have a bunch of slides that go over those. But when we talk about bonds, all we really are looking at is, are we selling them at par value, at a discount, or at a premium? And what do the journal entries look like in each of those scenarios? Okay? So assuming that we sell at par, this is very easy because it obviously doesn't add the complication of a premium or a discount. But anytime, no matter what, whether we're selling at par, discount, premium, no matter what, the semi-annual interest payments that we pay, assuming they're semi-annual, that's most bonds pay out semi-annually, but the semi-annual interest payments are calculated the same regardless of whether there's a premium, a discount, or just par value. Because the way you calculate the interest payments is you just take the stated rate on the bonds times the par value, and in this case, since it's semi-annual, you multiply that times half to give you half of the year's payment. Okay? So no matter what, the cash flow that's going out to this bond holder is going to be $36,000. Now, if it's sold at a premium or a discount, then they gave me more or less money up front in order to get this cash flow paid to them semi-annually, but that is going to be the cash flow they get no matter what. Okay? Then at the end of the day, assuming I issued at par, the amount that they get back is the same amount that they loaned me. Okay? So they loaned me $800,000. I paid 9% interest on that each year that I was borrowing that, and then I paid back the amount that they loaned me. That's the simplest way. That's bonds at par, right? But then we also need to look at the other two options, bonds at a premium or bonds at a discount. So if the face value of your bonds is less than the market rate, they sell at a discount. If it's the same, they sell at par. and if the face value of your bonds is greater than what you see in the marketplace, then they sell at a premium. That should be pretty self-explanatory. Okay? If you are offering something better than everyone else, you're going to get a premium for it. If you are offering something that's worse than what everyone else is offering, you're going to have to sell it at a discount. Okay? All right, so here's an example of issuing bonds at a discount. Okay? We've got the stated interest rate of 8%. That's what our bonds say on them. So that's the amount that we're going to use to calculate the semi-annual interest payments. But because that's less than the market interest rate, we're going to sell these at a discount, right? The exact amount that we issue these at, looking at this and saying, okay, this is 2% difference, so exactly how much of a discount should I issue that at? That's beyond the scope of this course. That gets into some present value concepts. Go into accounting and take intermediate accounting. We'll talk about that more there. In this class, you'll always be given the exact discount or premium that you're going to issue at. Okay? So in this case, we're saying, hey, based on these numbers, we should issue, the discount that we should issue this at is 96.45% of par value. Since par value there is a nice even $100,000, that issue price comes out to $96,454. Okay, leaving us with a discount of $3,546. Okay, again, what that means is because our interest rate is less than what they could get out on the market, we said, hey, loan us $96,454 today. In, I forget how long we said this was, 20 years or however long these bonds are good for, we'll pay you back $100,000. Okay? So right there, the difference between what they're giving us and what we're paying them back, that $3,546, you could look at that as a type of interest. Because what interest is it's just the cost of borrowing money, basically. Right? This is an amount of money that we are paying back, okay, even though we're paying it back at the end of this period, we're paying that back above and beyond what they gave us. So this is just another way of calculating interest. Okay? So a premium and a discount, again, since the whole reason we did this was to make up for the difference in market and face value of these bonds, this is just basically prepayment of interest, okay? Or essentially we're saying, hey, this $3,546 of interest, instead of paying it out semi-annually, we're giving it to you right up front by taking it away from the amount you're giving us, okay? And paying you back that greater amount at the end of your investment. So, if you were to look at this amount, you would say, okay, what's the total amount of interest that I'm paying here? We've got the 4 payments, the semi-annual payments that we figured, of $4,000 each, which we get by taking principal times interest rate times half a year. Okay, so that's $4,000 for each payment times 4, $16,000. We also have to pay back $100,000 at maturity. Okay, so that means at the end of the day, we will pay over to the bondholders $116,000. They gave to us $96,454. So the difference between what we're paying back to them over the course of the bond and what they gave us is the total amount of bond interest that we have for this instrument. Okay? Even though $16,000 of that is actually calculated as interest, and the other $3,546 is called a discount, but you'll see when we do the journal entry here that it still gets captured within the interest expense. Okay? So each semi-annual payment that we make, okay, now we'll have the $4,000 in cash that we paid out. And again, we got that by par value times interest rate times half because it's twice a year. Okay? So that's the cash we pay out. But a portion of the discount that we recognize is going into and being captured within interest expense. Okay? Remember, the interest expense account here tells us what's going on the income statement. Recognized expense, right? So what we're doing basically, at the beginning of the transaction, we figure what the total premium or discount is going to be, right? Then we take that amount and divide it into equal portions to go along with the interest payment. So in this case, let's see, we had 4 separate interest payments, right? Because we have, each of these $4,000 payments. So we took the entire discount, divided it equally by the 4 periods, and this is a rounded number, so it doesn't come out quite equally, but that gives us the $887. Okay? I know this concept can be fairly confusing, but the easiest way to remember this is the discount or premium account is kind of just a placeholder account, okay? Because the discount or the premium happens right at the beginning of the bond issue, but we want to recognize the effect of it. How does it affect interest expense over the entire length of the loan, okay? So instead of recognizing the full discount right up front as an interest expense, right when it happens, we're dividing that discount over the life of the loan and recognizing equal portions of that every time we have this 887 here and the 887 corresponding within bond interest expense. Each time we do that, the amount that's sitting in that discount account goes down, and the amount of that discount that we initially had that gets recognized as an expense goes up. So eventually we want the full discount to be all gone, so we want to take that down to 0, okay? And all of that discount at that point will have been captured within interest expense. So this is what you're seeing happening here, okay? So this is the full discount originally. As we take 887 each time, roughly, the amount that's remaining in the discount goes down until when that last repayment happens, when we pay back the principal, how much is left in the discount account? $0. Okay? So the discount account and the premium account are just ways that accountants have developed to allow us to recognize interest expense over the entire length of this instrument, even though we basically have an interest rate on the face of it that's outdated and not corresponding to the actual market rate that is available. Anybody not confused enough that they can formulate any questions on this? I know it's somewhat confusing. Hopefully when you go through the examples it'll help a little bit. Yes, sir. Okay, so remember, like how did I find this original amount? Okay, that's always going to be given to you. Okay, so in this one, in this one it was given to you right here. Oh, not right there, sorry. Right here, because we basically said right off the start, here's the discount. Okay, so for principles of accounting, it'll always be on a plate handed to you. Here's the discount, here's the premium, and all you'll have to do is divide it into the number of payments. Okay. Okay, so going back here. So when we talk about a premium, we're doing basically the exact same thing, but it's kind of flip-flopped. Okay? The premium still captures that difference between the amount of cash we're getting at the outset, right here, and the par value. Okay? So par value here, amount of cash we get here, what's the difference? That's either the premium or the discount. If it's more than the par value, that's the premium. If it's less than the par value, that's the discount. Okay? As far as the journal entry goes, the cash and the bonds payable will always be a component of this. If it's not sold at par value, there will either be a premium or a discount, and where that goes corresponds with where it needs to go to balance the equation, right? So bonds payable will always be the par value amount, okay? So if cash is less than that, then you will need to add something to cash to get to this. So you would have a debit on the cash side. If it's more than that, then you want to add to the credit side to balance out. So in this case, the premium goes on the credit side so that the credits and the debits balance. Again, all we really need to do is determine difference between cash coming into us and par value. Once we determine that, we do the same thing again. We figure out how many periods are we going to be paying out interest on this, and we'll divide the premium by that many periods. Okay? So that would be, again, right here. So the same amount is happening now. We still have that $887 because the total amount that we had is still divided by 4 periods and still gets us to this $887. The difference is that now that $887 is causing the amount of interest expense that we recognize to be less than it otherwise would be. See, we're recognizing less interest expense here than the cash that we're paying out. Okay? Why is that? Because we're effectively saying this amount, this $887, you gave that to us up front, and now we're essentially giving that back to you, giving that portion back to you of the premium that you paid, so that by the end of the day, we'll give that all back to you in the form of interest expense. So interest expense will be that much lower than it otherwise would have been because we have that extra money coming in as a premium. But it looks just the same here. Okay? We started out with the same amount of unamortized premium, and again, that just means we haven't started taking money out of that yet. Okay? We haven't started that yet. Once we amortize that, amortization just means divide into equal payments. So once we amortize that, we divide it into 4 equal payments. Every time we make a payment, that goes down until finally, when we go to pay off the principal of $100,000, we have $0 left in the carrying amount. So the graph looks like that. So this line here is the carrying value, which is essentially the amount above and beyond par value to include the remaining premium that we are reducing until we get to the end there. Anybody have any questions on the premium side? All right, so I left these slides in here, these next 2 or 3, just to show you that this exists, or to briefly talk about the concept. But again, well beyond the scope of this class is the concept of time value of money, where we know that anytime we're talking about cash inflows or outflows in the future, the time value of money comes into play where we need to discount the future cash flows based on whatever the interest rate is. Like I said, it's a concept that's a little bit beyond the scope of this class, but just keep in mind that as someone paying out cash outflows or as someone receiving cash inflows, in reality, if we have to put a value to those, first we would look at discounting them to their present value and then going from there. Like I said, if you stay with accounting and move into intermediate accounting. That's a lot of what you'll do in that class, is working through time value of money, figuring out how to calculate the correct amount for the discount, for the premiums, and then also how to make sure you have the correct carrying values on your financial statement. However, for the purpose of this class, we'll keep it more simple, and we'll look at the values kind of in a vacuum as far as the time value of money goes. At the end of the day, though, when you retire bonds, this looks just like any other type of liability, where if you have a payable account, carries a credit balance. So if we want to reduce that credit balance to 0, then we need to put the debit amount into that account, and then of course we would credit cash for that amount as well. All right, so that's kind of my my spiel on bonds. Now looking at notes payable. I actually don't have a ton to talk about with notes payable because the accounting for them functions very similar to accounts payable, which we've talked about throughout the class. The main difference between notes payable and accounts payable, other than the formality, is interest, right? So the concept of interest. Interest for any type of debt and figuring out how much interest to pay functions just like we did with calculating for the bond. You take the principal, you multiply times the rate, and divide based on how many times per year you're doing it. All that to say is most of the stuff we're talking about here with notes payable are things we've already covered in other areas of the class. Let's see here. When we talk about long-term notes payable, we're obviously talking about time to payment being more than a year out. With this particular type of note payable, we're talking about a single payment of principal plus interest. That means we're making no payments during, in the meantime. Okay? So if I have a 3-year note payable, then I don't pay anything, assuming the single payment of principal and interest, until that 3 years is up, at which point I will pay for the full 3 years of interest plus the full principal payment back. That's less frequently used. You can imagine why that might be. But most of the time, a lender would much prefer to have these periodic payments, right? Where from the note date to the maturity date, you have monthly or quarterly or however often payments of both principal and interest that serve to pay down the principal, and also compensate the lender throughout the course of the loan for providing that. So that would be an example of what we would call an installment note, where we have a note payable that we are paying out in installments. So a mortgage or a car loan, these would be examples of installment notes that y'all should be fairly familiar with. And these can come in a bunch of different shapes and varieties and flavors, but most of the time the accounting for them all looks pretty similar, regardless of how they calculate the interest or whether you're paying the same amount of interest every time and only the principal's changing, or however you structure the deal, the accounting for it looks pretty similar. At the outset, when we get the loan, the money coming in is recorded as a debit to cash, and the principal that we'll have to pay back is recorded as a credit to notes payable. Okay. Then, of course, as time passes, we'll make these payments here. So each payment in this example has the same rate. So this would be a good example of like a mortgage or a car loan, where as time passes, it's not the rate that you're paying that changes, but the amount of that payment that gets allocated to paying off your principal changes as time passes. Because the way that you calculate your interest expense is you look at however much of the principal is outstanding whenever you are coming to make this payment, and you multiply that amount of principal times the amount of interest, or I'm sorry, times the interest rate that exists, and that would give you the amount of interest that you have to pay. Okay? So once you have that, if you know the amount that the payment is, then whatever the difference is between the interest that you owe that time and the payment is the amount that can go towards your principal. So if you've ever looked at the schedule of payments on like a car loan or whatever, you'll notice that at the beginning of the loan, almost all of your payments is going straight to interest. And very little of that is going to your actual principal, which is what's lowering the amount that you owe to the lender, right? As time passes, little by little, the amount that's in your principal goes down, okay? Because each time that notes payable is debited, that means you owe less, right? So each time that happens, there will be less principal to charge against that interest rate, which means each payment would have a greater percentage going towards the principal. That's also why, like if you have a mortgage or a car loan, anything like that, you know they figure out your payment schedule. But if you have extra money each month, in addition to this, anything above and beyond that payment amount that you pay can go straight towards the principal, right? So you could actually, let's say I wanted to pay $15,000 this period, assuming I'm trying to pay this off early, then that extra, $2,000 plus would go straight to this notes payable and not to the amount going towards interest. So like I said, a car loan is an example of that, and then also mortgage notes also very a function with that type of installment note characteristic. Anybody have any questions on any of these? All right, that's all I have for this chapter. So, like I said, examples are posted. If something comes up and you guys have any questions or need more examples, give me a shout. Otherwise, welcome back.